At 2:14 a.m. Eastern Time this morning, while this country was asleep, the silver market fell 1.85 in 60 seconds, not over an hour, in 60 heartbeats. 185 vanished. The headlines this afternoon will call it normal volatility. They'll blame algorithmic trading or thin overnight liquidity. They will be wrong. This wasn't a random event. This was a signal, a mechanical symptom of a hidden structure that is now reaching its breaking point. A structure so predictable, so embedded in the architecture of modern markets that once you see it, you'll understand why these events are not accidents. They are inevitabilities. And what happened at 2:30 a.m. isn't the story, it's the confirmation. Stay with me, because in the next 20 minutes, I will show you the engine behind the chaos. Not the rumor, not the hype, the cold, hard mechanics. And by the end, you will know exactly what this means for what comes next. Let me be absolutely clear about what this move was not. It was not caused by a surprise Fed announcement. The FOMC is next week. It was not caused by a major geopolitical event. The wires were silent. It was not even caused by a massive visible sell order from a known fund. So what did cause a 9-figure market to buckle in the dead of night? The answer is not a what, it's a how, a specific mechanical protocol written into the very code of derivative markets. We are witnessing the direct result of liquidity vacuum propagation. Think of it like this. The modern price you see on your screen for silver, for gold, for most major assets, is not set by physical bars changing hands. It is set in the derivative layer, the futures and options markets. This is a world of leverage, of margins, of collateral chains. And at 2:30 a.m., the liquidity in that layer, the available capital ready to buy or sell, is at its absolute thinnest. The human traders in London are hours from their desks. Asia is winding down. The market is running on algorithmic custodians. Now, inject a single moderate-sized sell order into this shallow pool. The first algorithm hits its bid. The next algorithm, seeing the price drop 10 cents, is programmed to defend its own position. It sells to hedge. This triggers a third algorithm, which is monitoring volatility thresholds. That third algo is not selling silver because it believes in silver's fundamentals. It is selling because a rule was met, a rule about portfolio correlation and value at risk. This creates a cascade, not of panic, but of cold binary logic. Each sell order consumes the meager available bids, driving the price lower to find the next bid. And with each drop, more machines, tied to more rules, are triggered. The liquidity pool didn't just get smaller, it evaporated. For 60 seconds, the market was not trading a metal. It was executing a pre-written script for a low liquidity environment. This is the hidden mechanism. This is the engine. This is not new. It is a pattern etched into financial history, repeating every time the derivative layer grows too large relative to the physical foundation it's supposed to represent. Let me show you the pattern. Same sequence, same cause, same outcome. Stage 1, the physical anchor. Every sustainable market begins with a tangible foundation, actual goods, actual delivery, actual buyers and sellers meeting in a place, physical or electronic, to transfer a real asset. This creates a genuine price discovery. The early silver market, the grain pits, the oil trades. The volatility exists, but it's anchored to something real. The bid might be low, but it's a real bid for a real thing. Stage 2, the efficiency layer. To smooth out volatility and allow for hedging, the derivative is invented, a futures contract, a promise to deliver that physical asset at a later date. This is powerful. It allows producers to lock in prices. It attracts speculators who provide liquidity. The market grows more efficient. The paper market and the physical market move in relative harmony. The foundation is still there. Stage 3, the derivative dominance. This is the turning point. The volume of paper contracts, the promises to buy or sell, begins to dwarf the actual physical asset available for delivery. Why trade heavy, costly bars when you can trade a digital contract with 20-to-1 leverage? Participation explodes. But a subtle shift occurs. The tail begins to wag the dog. The price starts being set more by the flows of paper contracts than by the flows of physical metal. The anchor is still there, but the chain is getting long and heavy. Stage 4, liquidity illusion. The market appears incredibly deep, incredibly liquid. But this liquidity is a phantom. It is the liquidity of offsetting paper promises, not of committed capital ready to take delivery. It is built on margin debt and cross-collateralization. The system feels robust, but it has become a network of interdependent IOUs. This is where we have been for years in silver, in gold in many markets. Stage 5, the vacuum events. This is where we are now. The system is so optimized, so reliant on constant, ample liquidity, that it cannot handle withdrawal. A minor tremor, a modest sell order in thin hours, a minor bank stress, a margin call elsewhere in the system, encounters not a deep pool of buyers, but a hall of mirrors. Algorithms talk to algorithms. Liquidity, which seemed vast, proves to be shallow. Flash crashes, gaps. These are not anomalies, they are diagnostic tests, and they are happening more frequently. Stage 6, the physical disconnect. The paper price and the physical price begin to diverge in a sustained way. The paper market trades based on financial mechanics, interest rates, dollar strength, ETF flows. The physical market trades on availability, on premiums, on the simple act of wanting the thing and holding it. The premium to acquire a real bar of silver or a real coin surges even as the spot price on screen dips. The two worlds are separating. Stage 7, the reset. The derivative structure, unable to reconcile its promises with the physical reality, resets. This is the squeeze, the failure to deliver, the forced contract roll at catastrophic cost. The wealth transfers violently from those holding only the paper promise to those holding the physical asset. The pattern is complete. What happened at 2:30 a.m. was a stage 5 event, a liquidity vacuum in the paper layer, a warning shot. Do not take my word for it. Let's look at the data from today, right now. Look at this. On the left, the paper price, a violent, ugly collapse to a number we'll call $28.50. On the right, the real-world price to buy a single ounce from a major dealer, $35.95, a $7.45 premium, over 26% above the spot price. This is the disconnect. The screen price is the price of a digital promise for 5,000 ounces, settled in cash months from now, traded by machines at 2:30 a.m. The $35. $95 is the price to walk out of a store with a coin in your hand today. One of these prices is reacting to margin calls and algorithmic rules. The other is reacting to stock levels, shipping costs, and immediate demand. Now track the inventory. While the paper market gyrates, the physical metal is leaving the exchange warehouses, a steady, quiet outflow. This is not speculation. This is registered inventory, metal available to back those paper contracts, dwindling. The foundation is shrinking while the paper skyscraper built on it gets taller. This is the core of the modern market illusion. You are quoted the paper price as if it is the price, but it is merely the price of the most liquid, most leveraged, most disconnected layer of a multi-layered system. The 2:30 a.m. flash crash was a spasm in that top layer. The real metal, and the people buying it, barely flinched. This is where it becomes a psychological game, and it is played masterfully. The immediate narrative will be, see, it's volatile, it's dangerous, it's a manipulated casino, you should sell. Ask yourself, who benefits if you internalize that narrative and sell your physical metal today at a panic price based on a 2:30 a.m. algorithmic event? First, the short-side paper traders. Their entire position profits from a lower paper price. A flash crash creates fear, which can trigger further selling from retail and funds, pushing the price lower, benefiting their books. They want you to see the screen and react emotionally. Second, the system itself. A volatile, scary paper market drives participants away from physical ownership and into paper proxies, like ETFs. Why deal with storage and premiums when you can buy SLV? This keeps you in the derivative layer, where your investment is just another IOU in the system, subject to its rules and its liquidity vacuums. They want you in the matrix. The panic narrative is a tool. It seeks to convert a structural event, a liquidity vacuum, into an emotional response, fear selling. It seeks to make you, the holder of a real asset, behave as if you are holding the volatile paper contract. It blurs the line between the two worlds because that confusion is profitable. Do not fall for the theater. The signal is not the price move. The signal is the widening gap between the paper price and the physical price. That gap is a measure of stress. Today, it screamed. So what comes next? Not a prediction, a calculus. We have established the conditions, a derivative layer dominant and prone to liquidity vacuums. A physical foundation that is tightening, falling inventories, high premiums, a palpable disconnect between the two. History shows that this condition cannot persist indefinitely. The pressure will seek a release. There are two paths. Path A, the paper, reclaims control. The price smash succeeds. Fear-driven selling in paper ETFs and futures overwhelms physical demand. The premium collapses. Physical buying slows. The paper price and physical price reconverge at a lower level. The structure resets, wounded but intact, ready to repeat the cycle. This requires a sustained, overwhelming force of selling in the paper market. Path B, the physical breaks. The paper. The paper price, driven lower by financial mechanics, falls to a level so absurdly disconnected from physical reality that it triggers a tidal wave of global physical buying. Mints run out of product. Premiums explode further. The warehouses hemorrhage metal. Eventually, the paper market faces a delivery crisis. Too many promises, not enough metal. The price then must explode higher to shut off demand and attract metal back into the system. This is the reset. The urgency is not that one of these paths will happen. The urgency is that the system is now so tense that the next liquidity event, a failed bank auction, a surprise central bank purchase, a margin call in another asset class, could be the trigger that chooses the path. The clock is not on a geopolitical timeline, it's on a structural one. Each flash crash weakens confidence in the paper price's legitimacy. Each ounce that leaves an exchange warehouse strengthens the physical side's hand. We are in the phase where the frequency of these diagnostic shocks increases. This is not a call to panic, it is a call to clarity. To see the market for what it is, two parallel games being played with the same name. Your strategy must flow from this understanding. First, define your game. Are you trading paper contracts, ETFs, futures, miners? Then, you're playing in the algorithmic arena. Your rules are technical analysis, liquidity timing, and risk management against flash crashes. Respect the game's rules. Do not hold leveraged paper positions into thin overnight hours. It is suicidal. Are you acquiring physical metal? Then you are playing a different game. Your price is the dealer premium, not the spot. Your chart is the inventory report, not the minute candle. Your time frame is measured in cycles, not milliseconds. The 2:30 a.m. crash is a relevant noise. The relevant data point is that your cost to acquire real ounces remained stubbornly high. Second, use the disconnect. The gap between paper and physical is not just a warning light. It is an opportunity for those who understand the structure. When the paper price plunges on a vacuum event and the physical premium holds or rises, it is a signal of underlying physical strength. It is the market telling you its secret. Third, build optionality. Do not be all in on one expression of your thesis. If you believe in the physical story, your foundation is metal in your possession. But understand the paper game well enough to potentially use its exaggerated moves to add to that foundation strategically. Conversely, if you trade the paper, understand that your exit depends on a liquid, functioning derivative market. Have a plan for when it briefly doesn't function. Fourth, ignore the noise, watch the mechanism. Stop watching the price ticker with emotion. Start watching the metrics of structure, the COMEX warehouse stock levels, the premium on major retail products, the volume traded in the dead of night versus the London NY overlap, the open interest in futures relative to deliverable supply. These are your gauges. The price is just an output. The 2:30 a.m. flash crash on today's date was not an anomaly, it was an inevitability. It was the direct logical output of a market structure where derivative promises have outgrown their physical foundation, operating in an environment of curated scarcity. This is not about doom, it is about mechanics. The wealth transfer happening is not from one group of people to another. It is from uninformed strategies to informed ones. From those who see a price crash and panic to those who see the same crash, check the physical premium and understand they are being shown a profound weakness in the system's design. The pattern is absolute. Stage 5 events lead, inevitably, to Stage 6 resolutions. The only variable is time and the trigger. Your task is not to predict the exact day. Your task is to position your strategy so that the path the system chooses matters less to your outcome. To be grounded in reality, not in the flickering illusion of a screen. The next diagnostic shock will come. It could be in gold, it could be in the bond market, it could be tomorrow night at 3:12 a.m. When it does, you will no longer see chaos. You will see mechanics. You will see the engine revealing itself once more. If this analysis shifted your perspective from watching prices to understanding structures, your next step is clear. Subscribe. Hit the notification bell. Because in my next video, I will map the precise contagion pathways, how a liquidity vacuum in silver can trigger a margin call in stocks, which can force a sale in bonds, and I'll reveal the single most vulnerable node in the entire global leverage chain. You need to see this map. The shocks are not random, they are connected, and the connections are about to be tested. The structure is stressed, the pattern is clear, the time for informed action is now.